Most revolutions are loud. This one began with silence and a spreadsheet. In a world obsessed with beating the market, one man dared to ask a forbidden question: what if no one can? His name was John C. Bogle, and he would become the most hated man on Wall Street and the most beloved man in the history of investing. Because Bogle didn't invent a new way to get rich, he invented a way to make sure everyone else could. To understand Bogle's rebellion, you have to picture the world before it. The mid-28th century, Wall Street was a cathedral of confidence. Investment managers in tailored suits promised investors they could beat the market. They charged high fees, traded constantly, and spoke in a language so complex it sounded like magic. The message was simple: you can't do this alone. Trust us. And people did. By the 1960s, billions of dollars flowed into actively managed mutual funds. Every broker claimed to have the secret formula, the inside edge, the unbeatable strategy. But the data told a different story. When economists began studying fund performance, they discovered something shocking. Almost none of them beat the market over time. Most didn't even match it. And the few that did often lost their advantage once fees and taxes were counted. It was a truth so uncomfortable that Wall Street ignored it. But one man didn't. In 1951, a 22-year-old economics student at Princeton University sat down to write his senior thesis. His topic: the economic role of the investment company. That student was John Bogle. While his classmates dreamed of joining investment firms, Bogle was more interested in their flaws. He examined decades of fund data and found that most mutual funds failed to outperform the market itself, and that the few that did couldn't sustain it. His conclusion was quietly radical. If investors can't reliably beat the market, the smartest thing to do is simply own the market. In other words, instead of trying to pick the best stocks, buy all of them at the lowest possible cost and hold them forever. To his professors, it sounded naive. To Wall Street, it sounded insane. After Princeton, Bogle joined Wellington Management, one of America's most respected investment firms. He worked hard, rose quickly, and by his mid-30s became CEO. He believed in discipline, honesty, and service to investors, values that were already going out of fashion. Then, in 1974, disaster struck. Wellington's aggressive merger with a speculative management group backfired catastrophically. Markets fell, clients fled, and Bogle was fired from the company he had helped build. It was humiliating, but that firing would turn out to be the greatest opportunity of his life. Bogle didn't retreat. He founded a new company, the Vanguard Group, with a mission no one believed in: to create a mutual fund that didn't try to beat the market at all. It would own the market, every stock, every sector. No trading, no speculation, no star managers. It would be boring, deliberately boring. Wall Street laughed. They called it Bogle's folly. But behind that laughter was fear. Because if his idea worked, it would expose the entire industry's illusion that experts were worth their price. In 1976, after 2 years of struggle, Bogle launched the world's first index mutual fund, the Vanguard 500 Index Fund, tracking the S&P 500. Investors hated it. Only $11 million was raised, less than 10% of what he needed. Financial magazines mocked him. Competitors called it un-American. But Bogle was unmoved. He believed that the future wasn't about chasing winners, it was about eliminating losers. And in investing, the biggest loser was cost. He once said, "In investing, you get what you don't pay for. The less you pay, the more you keep." His mission wasn't to make headlines, it was to make sense. And while Wall Street laughed, something subtle began to change. A new generation of investors, young, skeptical, and analytical, started asking the same question Bogle had asked at Princeton: why try to beat the market when you can simply own it? For nearly a decade after launching his index fund, John Bogle was treated as a ghost of Wall Street. He wasn't just ignored, he was ridiculed. While brokers sold dreams of fast gains, Bogle sold patience. While fund managers bragged about alpha and edge, Bogle spoke about simplicity and humility. In an industry built on ego, he preached restraint, and for a long time, no one wanted to listen. The Vanguard 500 index fund was an idea decades ahead of its time. It didn't promise to pick the next Apple or Microsoft. It didn't claim to know when to buy or sell. It simply tracked the market exactly as it was. To most investors in the 1970s, that sounded lazy. Wall Street prided itself on intelligence, not imitation. Analysts believed markets were puzzles to be solved, not mirrors to be reflected. But Bogle saw something they didn't. That markets weren't puzzles, they were reflections of human behavior. And human behavior was unpredictable. Instead of trying to outsmart the chaos, he decided to embrace it. Don't look for the needle in the haystack, he liked to say. Just buy the haystack. Every word he spoke was a challenge to the financial elite. And every year, quietly, his idea started to work. By the 1980s, data began to expose what Bogle had known all along. Most active managers failed to beat the market. After fees and taxes, nearly 90% underperformed the S&P 500 over long periods. The math was brutal. If the market returned 10% and a fund charged 2% in fees, the investor kept only 8%. Year after year, that small difference compounded into a fortune, or a fortune lost. And while other fund managers spent millions marketing their success stories, Bogle's truth spread silently through word of mouth and the power of compounding. By the end of the decade, Vanguard's assets had quietly grown from millions to billions. Still small compared to Wall Street giants, but no longer a joke. Then came the next phase of the revolution, the rise of ordinary investors. For most of financial history, investing was a privilege, limited to the wealthy, the educated, or the connected. Bogle changed that forever. Through Vanguard, he built a system where anyone, a teacher, a mechanic, a nurse, could own a slice of the entire economy with a single purchase. No middlemen, no secret fees, no insider advantage. It was financial democracy in its purest form. He often said, "The magic of compounding returns is overwhelmed by the tyranny of compounding costs." And he was right. Over decades, even small fees could consume half of an investor's total return. But with index funds, costs were so low that the money stayed where it belonged, in the investor's pocket. Wall Street hated it. Bogle wasn't just challenging their ideas, he was dismantling their business model. The more people chose index funds, the fewer commissions brokers earned. The quieter Bogle's revolution was, the more dangerous it became. The 1980s became a philosophical battlefield between faith in genius and faith in math. Active managers claimed that superior intellect could still beat the market. Bogle countered with brutal simplicity. In the short run, the stock market is a voting machine. In the long run, it's a weighing machine. He believed success in investing wasn't about prediction, it was about discipline. And as computers made data more transparent, more investors began to see the evidence for themselves. Charts, reports, and independent studies all confirmed the same pattern. Year after year, the average investor did worse than the market. The numbers didn't care about charisma, marketing, or confidence. They cared only about arithmetic, and arithmetic was on Bogle's side. In 1987, the stock market crashed again, this time in a single day. It was called Black Monday, October 19. Markets fell over 20% in hours. Billions vanished in a panic. Once again, most active funds failed to protect investors. They sold too late, bought too early, and missed the recovery. But Vanguard's index fund? It didn't panic. It didn't move. It simply tracked the market, falling when the market fell, rising when it rose, and when the dust settled, it had performed better than most active funds. For many investors, that was the turning point. They began to see that maybe, just maybe, Bogle's boring idea wasn't foolish. It was freedom. By the 1990s, John Bogle had become a reluctant legend. Vanguard's assets were soaring. Competitors who once mocked him were now launching their own index funds. Even as others tried to imitate him, None could replicate his conviction. Because for Bogle, this was never just about finance. It was about fairness. He saw the stock market as a partnership between corporations and citizens, and he believed Wall Street had forgotten its duty to the people who made it possible. He often called his investors the rightful owners of capitalism. To him, the real purpose of business wasn't to serve shareholders, but to serve society. And while others chased billions, Bogle built trust, one honest percentage point at a time. By the dawn of the 21st century, John Bogle's quiet rebellion had become a global movement. What began as a single folly fund, with $11 million, now controlled trillions. The financial establishment that once mocked him had transformed into his echo chamber. But Bogle himself never changed. While others built empires, he built a philosophy, one based on trust, simplicity, and the radical idea that investors didn't need to outsmart the market to succeed. They just needed to stop fighting it. Bogle's insight was simple, yet revolutionary. The market, over time, reflects the growth of human enterprise, not speculation, not manipulation, but productivity. Every company that builds something useful, every worker who creates value, contributes to that growth. And if you own a piece of the market, you own a piece of that progress. The genius of index investing wasn't in complexity, it was in humility. Admit what you don't know, minimize what you waste, and let time do the heavy lifting. The math proved unstoppable. By investing broadly and keeping fees close to zero, an index fund could outperform 80–90% of active funds over long periods. It was financial evolution, and the survival of the simplest. The more the world tried to ignore it, the more undeniable it became. Despite his success, Bogle lived modestly. He never owned a yacht, a private jet, or a mansion. He gave away much of his wealth and refused to profit personally from Vanguard's structure. Vanguard wasn't built like other firms. It was owned by its investors, not by outside shareholders. That meant its profits were returned to the very people who invested in its funds, lowering costs even further. It was capitalism turned inside out, a system designed to serve the many instead of the few. Bogle called it mutuality, and he meant it literally. To him, Vanguard wasn't a corporation. It was a community. He believed that finance should be a servant to society, not its master. And that belief turned him into something Wall Street rarely produces, a moral compass. The greatest enemy of a good plan, he said, is the dream of a perfect plan. He taught millions to stop chasing perfection and start trusting time. By the time Bogle retired, index funds had transformed investing forever. They democratized wealth creation on a scale the world had never seen. Ordinary people could now invest with confidence, not by predicting the future, but by participating in it. Teachers, factory workers, students, all could own the same portfolio once reserved for billionaires. This was revolutionary. Vanguard became one of the largest financial institutions on Earth. And Bogle's simple idea, to let markets work instead of fighting them, had quietly redefined capitalism itself.